What's going on, everybody? This is your host, Mr. John Legaretta, coming at you guys with the beginner ramp up video collection. This is number 2 to our video series, guys. And again, I'm super excited to be able to share this information with you guys. We are going to be diving, a little bit deeper today than we did on the previous video. So I want you guys to definitely get your notebook, get your pen, and we are about to go ahead and start up this phenomenal training. Now, before we actually go ahead and start our curriculum with our segments, I actually wanted to just dive a little bit deeper into our risk management as you guys are getting closer into actually practicing on a demo account on your MetaTrader 4 and simulating the process as if you were trading your real capital, whether it's on your own account or whether it's on a funded account. So you guys must learn this information before you actually simulate the process on a practice account. So when you're doing everything on the real account, there would be no difference, and you guys already have the experience you need in order for you guys to be successful. So let's dive right into the information, guys. This is going a little bit deeper into risk management. Now, listen, when we are trading, guys, two of the most important aspects is going to be your stop loss and it's going to be your take profit. I want you to understand that in every single trade, you're going to have obviously a stop loss, but depending on the trade, you will have a different range of risk in pips. Now, when you're going to receive these signals, guys, you can receive a stop loss range of negative 15 to negative 50 pips. It could be negative 15, could be negative 20, could be negative 25. Okay. And your take profit range of reward in pips is going to be from positive 20 to positive 100. Now, what are some examples of real signals when we do receive them? You're going to receive a signal that might say, we're risking 15 pips on this trade, but we're catching 45. We're risking 20 pips on this trade, but we are catching 60. We're risking 25 pips on this trade, but we are actually catching 75. So you guys got to understand these are all 1 to 3 risk to reward ratios. Risking 20, catching 60. Risking 25, catching 75. Now, please understand this. I'm going to actually go ahead and really add this in here. I would really write this down, guys. What are some tips, okay, on actually managing the signals that I take? Okay, what are some tips? I would understand this, guys. Let's say one of the most popular ways to receive a trade through our signals is risking 20, okay, but you're catching 60. Someone's going to tell me, well, do I always have to let it hit take profit, or can I take out the trade before? Well, I want to tell you guys this very important thing. Our take profit number one, okay, take profit number one is going to be at, let's say, the 20 pip mark. So if you're risking 20 and catching 60, when you hit positive 20 pips, guys, you will always have two different options. Number one, you can either close in profit, okay, or in order for you guys to go ahead and protect your trade, option number two is you are going to move, or in this case, adjust your stop loss to break even. I will give you guys a very clean example as I do show you guys exactly how a trade does work, but just write that down for now. Take profit one is at 20 pips. You can either close a trade in profit, or you can move your stop loss to break even in order for you to let the trade ride, but risk-free. Okay, risk-free, and you're able to hit higher take profits. Guys, take profit, okay, take profit number 2 is actually going to be positive 40 pips. Okay, TP2, positive 40 pips. Again, when you reach TP2, you also have 2 different options, either close in profit. I'll copy it here. TP2, either close in profit, or you guys can go ahead and move your stop loss to break even in order for you guys to go ahead and have a risk-free trade. Okay, we go to our final take profit, and that will be obviously take profit number 3, and that's going to be once your take profit actually gets hit at 60 pips. Now you can't move your stop loss or break even because at that point you actually ended up hitting your final target. Okay, once you hit your final target, the trade automatically closes for you without you having to do a single thing. So keep in mind, you reach 20 pips, either close in profit, or you want to capture more money, move your stop loss to break even, and let the trade ride risk-free. If the trade comes back down to the point of entry, you lose nothing. If the trade keeps going, then you can, smash 30, 40 pips. TP2 is 40 pips. Same options. TP3, well, the trade would automatically close for you because you have reached your final target. Now, understand there's 2 kinds of people that I'm talking to right now. If you're going to be trading your own personal account, or in this case, ladies and gentlemen, you're going to be trading your own personal funds, okay? Do not risk more than 10% of your total balance per trade. This is non-negotiable. Guys, I would write this down. You live to trade another day. Okay, you live to trade another day. Now, if you're going to be trading on a funded account, right, which we probably did speak about, you do not risk more than 1% again of your total balance per trade. This is, guys, also non-negotiable. So what's the advice that I can give you guys? You want to be able to live to trade another day. Sometimes trading really becomes, just about, that risk management. Okay, you don't want to put all your quote unquote eggs in one basket and blow your account on one trade. This is non-negotiable for your personal account, your personal funds. Do not risk more than 10% of the total balance. On your funded account, do not risk more than 1% of the total balance per trade. This is absolutely non-negotiable. You can always live to trade another day. Now, someone's going to tell us, well, you know what, John? Well, you know what, mentor? You know what, business partner? How do I know what lot size to pick? How do I know what this risk management whole thing is about? Well, we created a system for you. Look, get with your mentor for the risk management cheat sheet. Guys, for every account balance, we have a cheat sheet that says this is the lot size if you're trading on this size account. So all the answers as to which exact lot size to use per trade, we give it to you. So there's no guesswork because everything we do in this organization is completely calculated. Get with your mentor and have them send you, the risk management cheat sheet because the work has already been done for you, right? The account balance, what lot size to pick. I mean, at this point, your success really lies in being able to follow instructions on taking the signals, being able to understand that you're just going to follow the risk management cheat sheet and just don't risk more than what I put on here, guys. And you should be good. Also, being able to manage your trades correctly. TP1, 20 pips. TP2, 40. TP3, if that's your take profit, unless it's higher, then at this point it would automatically close for you. And don't forget to trail your stop loss. When the trade hits 20 pips, move that stop loss to break even. I'll give you guys an example to let the trade ride what? Risk free. Same exact thing. Move your stop loss to break even to let the trade ride risk free into TP3. So we want to be covering our tracks as we progress in every single trade that we actually do take. So let me go ahead and just remove this real quick. We go on to the very first segment of this training. So here it is. As a Forex trader, okay, I want you guys to understand that there's 3 different ways to enter the market. The very first way is something called a market execution. Now, a market execution just simply means that the trade activates immediately when you press buy. When you press sell on your MetaTrader, the trade will activate what? Immediately. Now, there's 2 types of market executions. There's something called a buy by market, and there's something called a sell by market. Now, where it gets a bit more tricky, and you don't have to spend all your time on this, but I would look into it, guys. But the second type of order to enter the market is actually called a limit order. Now, what are limit orders, guys? I put the little stars here. Limit orders are known as pending orders, aka these type of trades do not activate right away unless triggered. Again, the market execution activates immediately, but sometimes you're able to set pending orders in the market that will only activate at the specific entry price. What do I mean? You guys are able to see right here, buy limit. What is a buy limit? A rebound to the upside. What is a sell limit? A rebound to the downside. So let me go ahead. Let me copy this. And I'm going to take you on a little show with me. So you guys are able to see exactly what I mean. Yeah, let's actually do it right here. So let me go ahead and just paste this here so y'all have it. Erase this, press paste, and we're in business. So let's go over what a buy limit is. Ladies and gentlemen, we can see that this market is going down. Now, you're going to finish my sentence. Anything that goes down must go back up. We can see this small area right over here. Don't worry about my technical analysis, which I will go into. Just understand this. Ladies and gentlemen, can we agree that the market's up here right now? Let's say you have a projection. Okay, you have a theory that if the market comes to this point, it will literally bounce from this point and move on its way up. I'll give you guys a quick example. Gonna move this over here. Let me change this real quick. Put that red, put that thin. There we go. Put that over here. Perfect. So guys, let's say that we expect the market to come down, and when the market comes down, it's going to go ahead and it's going to rebound. So this would be an example of a buy limit. Let's say we're about to go to sleep. We expect the market to push down into this point, and when the market pushes down here, the trade then gets what? Activated. Market's up here, but when it pushes down and it hits this exact point, this red line in the market, the trade then gets what? Triggered, or in this case, activated, and it's going to shoot where? Let's say it's going to shoot up into this very specific area that I'm going to mark up right over here. Okay, this is just an example. So we see the trade here. You can set this trade as a pending order in your FTMO, but the trade will only be triggered and activated when it hits this entry price. You guys will see it comes down, gets activated, and shoots up. What is a buy limit? rebound to the upside. So rebound to the upside, rebound to the upside. Now, what if the trade, let's say, doesn't come down here, and let's say the trade just goes ahead and, let's say it just shoots up? Well, guys, if the trade's here, what if we have another projection, right? We're projecting that the trade's gonna come into this specific zone, and when it hits the zone, the trade will then get, activated. What if you can't look at your phone for, the next few hours because you're at work or you're sleeping, whatever the case is? When the market reaches this point here, my trade will then get what? Activated, and I'm expecting the trade to go where? To, let's say, continue going down, right? You guys see up, down, up, activates and pushes where? And pushes down. So what is this? This is considered a sell limit. So it's gonna rebound, but to what side? The downside. Rebound to the downside because it's a sell. For a buy limit, it's rebound to the upside because it is a buy. Now, those were actually two very clear examples of limit orders, right? Now we're gonna go into stop orders. This is the final one. Over here, let me actually scroll down. Let me copy this so you guys have it with me. And we'll break this down fairly quickly. Here we go. Grab the text. Grab the text. Okay. Erase this and we're gonna paste it. Bam, here it is. All right, guys, let's get rocking and rolling. So stop orders, guys, they're also pending orders, aka they do not activate right away unless triggered. Now, a buy stop is not a rebound. A buy stop is a breakthrough to the upside, and a sell stop is a breakthrough to the downside. So these are other forms of projections. These are other forms of projections. Guys, let's go with sell stop first. Let's say that we expect the market to just keep shooting down. And let's say we do this right over here. I'll give you guys a good example. Let's say instead of the market rebounding at this red line, instead of rebounding at this specific red line, what do we say? Man, I really think that the market's going to come down. And when the market hits this area, instead of it going ahead and rejecting, the market will now go ahead and it will what? It will break through. Okay, it will break through. So it will hit this area. The trade then gets what? Activated. The trade will simply get activated at this specific line, and instead of the trade rejecting, your trade gets activated for a what? For a breakthrough. So it's a breakthrough to the downside. A sell stop is a breakthrough to the downside. Trade comes down, gets activated specifically at this point, and it's going to break through into the take profit. Okay, because it's a sell. Guys, when it comes down to a buy stop, okay, when it comes down to a buy stop, very simple stuff. Let's say we say and we project that, okay, market's going to come to this specific area, and when it gets here, I don't think that it's going to reject. I think that it's going to what? It's going to break through into this zone. This is what it's going to look like. Right over here, bam. Market's going to break through into the zone. So this is the breakthrough. The trade obviously gets what? Activated in there. Right over here, the trade will get what? Activated at that specific zone. And let's say this is your projection of what the market is going to do. Okay, so those are stop orders. And I think at this point, I went over every single type of orders just so you guys understand. The final thing I will say is we don't really use too much of pending orders. Like we don't really use too much stop orders. We very seldom use limit orders, but I think 90%, 95% of the time, we are using market execution. Okay, guys, we go on to the second segment, and I want you guys to really take notes of this. But the second segment is the three types of analysis that traders use. The very first one being technical analysis. What is technical analysis, guys? Technical analysis is basically your price action. You're reading the past history of the charts in order to use the patterns that were left there in order to make projections. So what's an actual example, over here? Okay, let me erase a few things and I'll show you exactly what technical analysis is. Guys, have you guys ever heard of something that says, history tends to what? To repeat itself. I'll give you guys a really damn good example. Watch this, man. Watch this. Here we go. Gonna erase this. And we are in business. Here we go. Guys, when market came up here the very first time, right? Let's say market ended up coming down, which it did, and it ended up going right back up. You see, understand this. In the market, nothing happens by accident. So because the market went to this point before, when it reaches this point again, if it dropped right after reaching here, so it went up, it hit this area of resistance and it dropped, went back up. Using previous history of this price action, we can maybe make a projection that the market's going to fall like it did previously right here. So this is something called your technical analysis based on price action. In the most simple terms, price action is simply looking at the price of the market and what type of formation or what type of action is it forming. And that's essentially what it is. It's being able to read the charts and the patterns and using the past history to determine, future moves inside of the market. Guys, the second type of analysis is your fundamental analysis, which I will be going over, but your fundamental analysis, guys, is news events, global economic events, and different occurrences within politics, within media, within health, any type of occurrence that can have an impact on the economy that will affect the price movement of different currencies. Okay, now the third type of analysis is your sentimental analysis, which is how you feel about the trade, essentially your gut instinct, right? Your experience within the market based on what you experienced before and leveraging that experience to make better decisions. And it's essentially your intuition. So there's three types of analysis when it comes down to, making a specific trade. Now, understand this, guys, that there are three different types of traders. Now, these different types of traders, they are completely based on personality. All types of traders are successful no matter the style. So you don't have to fit in any one category because you feel like you have to. This is more so based on personality, and all these types of traders, all three, have individuals in them that are massively successful. The very first type of trader is a scalper. And a scalper is someone that likes to be in and out of the market very quick, very short-term trades where they're only looking to capture maybe about 5 to 15 pips at most. Guys, I want to let you know, most people in the beginning of their career, they think that they're a scalper because you're in and out of the market quick, just trying to make a quick buck. You're not a scalper. You're just inexperienced and you're so scared to lose money, or you see blues, that you just want to take your earnings out of the market quick, and you may think that you're a scalper. So I think almost every person in the industry goes through the scalping phase, but they don't really stay scalpers. Um, it all depends. But a scalper is in and out of the market quick, capturing 5 to 15 pips at most, and they are very short term trades. Now, an intraday trader is the type of trader that I am based on my personality. We are always looking to capture between 20 to 80 pips of range, and our trades may last, between 1 to 2 major sessions. So I like to trade New York. I can trade 8 to 12, and we may close a few positions in that one session. Or it may go into Tokyo or London, and then it may close out there. But we try not to hold trades, longer than a 24-hour period. It's usually 1 to 2 sessions. So it's like 4 hours to 24 hours at most that we hold trades, and we capture between 20 and 80 pips. A swing trader is someone that likes to capture 100 plus pips. Guys, understand that these trades can last for days to weeks, and they have a very long-term perspective inside of the markets. We go on to the very fourth segment, and it's actually showing you how to read fundamental analysis and economic news events. Now, I want you guys to take note of this website. This website is called forexfactory.com. Forexfactory.com. Okay. Now, when you're on the screen, you guys can see that we have today, which is Sunday, October 17th, and you can look at the rest of the entire week to see what's going to go on. Now, I want you guys to understand this. There are 3 types of impact folders. Yellow folders, low impact. Orange folders, medium impact. Red folders, high impact. I'm going to let you know right now, you're going to select filter, and we don't really care at all about low impact. We don't really care at all about medium impact. The only thing we do care about is high impact news. So we're going to go ahead and apply filter and remove the junk and only focus on what's important, guys. So understand this. On Monday, you can see high impact on what currency? AUD, the Australian dollar, okay? And at what time? At 8:30 p.m. is when that news will come out. So we want to definitely stay away from the news. Some people like to trade news. Some people don't like to trade news, guys. It's not good. It's not bad. It all depends on your level of expertise as a trader to be able to handle the news. Now, October 19th, Tuesday, we got clear skies. On Wednesday, you can see high impact on GBP and on CAD, 2 a.m. and 8:30 a.m. Okay, this is Thursday and this is Friday, guys. Sometimes you may have major impact, which is stacked folders. So yes, obviously red folders, but it's on the same currency at this time. The market's going to be very heavily impacted. It'll move many pips in a very short period of time. Okay, so this is how you're able to read news. Forexfactory.com. Make sure you apply the filter and keep up with our signals channel to understand how to actually be able to go ahead and read the news. So that's exactly what we do. Guys, we move over into our 5th segment, and our 5th segment is about reading the pairs. John, on my MetaTrader 4, on the signals channel, through the app, whatever the case is, there's so many different pairs. Like, how do they work? Well, guys, understand how to read the pairs. You're going to have a currency on the left, and you're going to have a currency on the right. The currency on the left is called your base currency, and the currency on the right is called your quote currency. Now understand that pairs are divided into two sections. Your correlating pairs, which correlating translates into these pairs that are correlating, they will generally, not all the time, and not 100% exact, but they will generally move in the same direction. And then the second side is your inverse pairs, which means that they will generally move in the opposite direction of each other. Now, what are some examples of correlating pairs that move in the same direction? Euro USD, gold. Gold is XAU USD, GBP USD, NZD USD. Guys, do y'all see how the USD is on the same side? Y'all see that? So if one goes down, then generally they must all be moving down because these are what? Correlating. If one pair is going up, then generally they should all be going up. So it's a great way to understand that these pairs are moving as a unit together at different pace. They're moving at different paces, but they are generally moving together unless there's something causing it not to. But that's what correlating pairs are for. What's another example? Euro NZD, GBP NZD, and let me go ahead and fix this right over here. This is AUD. Okay, this is AUD NZD. Also, look at the NZD on the same side. Now, we have something called inverse pairs that move the opposite. So gold, if gold goes up, USD JPY goes down. Why? Do you guys see how in XAU USD, the USD is on the quote side? But for USD JPY, okay, the USD is on the base side. Because they are on different sides, they are inverse. Gold goes up, UJ goes down. Gold goes down, USD CAD goes where? Up. USD CAD and USD JPY, they usually move in the same direction generally. What's another example of an inverse pair? Euro GBP and GBP USD. Do you guys see how the GBP is now on the opposite side? Well, since you're on the opposite side, okay, that generally means that this is an inverse pair. So that's super important. I want to wrap up, this second video explaining to you guys, how to go ahead and use this, website called TradingView to be able to mark up your charts, because no one really sat down and taught me. I had to learn this myself. Guys, I would take the name of this website down. This is called tradingview.com. Okay, tradingview.com. Now, over here on the right hand side, you guys can see that I have my currencies, right? They are organized based on correlating pairs. So let me move this. I have these, right, organized based on correlating pairs. Maybe not all of them, but this is just kind of like my style, and you guys can feel free to copy it as well. I have my cryptocurrencies, okay? I have two things that I personally like to look at. So let's kind of ignore these two right now. This is just like a personal preference, but look at the CHFs. USD CHF, CAD CHF, AUD CHF, NZD CHF, Euro CHF, GBP. So I have all the CHFs, the AUDs, the CADs, the JPYs, the USDs, the indices, and the NZDs. You guys see how I perfectly have them coordinated just like this. And again, y'all can do the exact same thing. If you want to add a currency to be able to add to something called your watch list, you go to the plus sign and you can add any symbol that you desire. Now, we go over to the left-hand side, guys, and you're able to see, your trend line. Okay? You guys are able to see your, right, horizontal line to maybe identify support and resistance right over here. Look, we can use this to identify an area of support. We can use the trend line to identify, okay, the trend. Okay, we can use the arrow to maybe project that this thing's gonna go ahead and push down. Okay, just fixing the color here. Project that it's gonna go ahead and push down. You can also even put a star next to the most important ones. But over here, guys, these are the only 5 that I use. The trend line, you guys saw it. The arrow, I just displayed it. The horizontal line to identify the floor or the roof of the market, I showed it right over here. A horizontal ray to also do the same thing as a horizontal line, but nothing to the left. And finally, a parallel channel, which is a bit more advanced, so I won't go into it. Then we go over the next one, which is a bunch of crazy things that you're not really going to need. The only one that you will see is my fib retracement highlighted. Just make sure you highlight it as well. You guys have the different ways to kind of color your chart and specific important zones. You have your rectangle to maybe mark up different zones that you like. You have your ellipse to mark up maybe a specific bullseye point, okay, that you like to maybe, go ahead and highlight. You have the curve, right? Maybe instead of the arrow, maybe you want to be able to use the curve again to, put out your projections. And you guys have the triangle to kind of do the exact same thing and kind of make it look, look cool, okay? Now, you guys have your text. That's the only one that I use here, so nothing too crazy. And you finally have your long position and your short position, guys. Your long position is saying, hey, this is a buy trade. The purple is profits. Okay, the purple is profits. And this black is the stop loss. That would be one for a buy. And you guys can also pick your short position, which means that you're projecting for a sell. Okay, this is what it might look like. Okay, match the price of the currency with the split. Put this at the end of the stop loss and put this at the end of the take profit, and that's how you're able to run a short position. These are the only 2 that I do have highlighted. You guys are also able to go ahead and measure how many pips something goes up or down. So from the price of this market right now to the top of this wick, guys, this is a 46 pip move. Guys, this is the daily chart. Let's say we go to the 4-hour. Let's say from this candle to the very top of this wick, this is 145 pips. Guys, the market moves tremendously. Let's say we go from down here to up here. We can measure this move here. This is 666 pips, okay? So the ruler will help you measure the amount of pips from one side to the other side that you desire. Now, the final thing that you guys can use this for is the different time frames. The 1 hour, again, the 30-minute, you're able to go ahead and break down the structure of the market into these lower time frames. Okay, so with that being said, guys, this was a mini tutorial on TradingView. Okay, you guys got all 5 segments on this second video, and you were able to read the economic news events, which you will start to understand further down in your journey. With that being said, guys, this is your host, Mr. John Legarreta. Have a great rest of the day, and I'll see you guys on video number 3. Take care.